Today I wanted to share the exact formula that allowed me to build a six-figure investment portfolio, because investing success is a function of a very simple four-step formula, where if you follow each of these steps, you'll be able to build your own high-performing, highly profitable investment portfolio. And you don't need to know modern portfolio theory to calculate your risk using standard deviation, which is the square root of your variance, to maximize your upside. No, you don't need any of that whatsoever, because what I'm about to show you, anybody can follow and is a hell of a lot more simpler. Now, once you know the formula that I'm going to share in this video, you'll be able to spend less than 1 hour per month supercharging your investment portfolio. So with that said, let's get into it. On the topic of superchargers, let's get into the first entry into the formula, which is your vehicle. With any journey where you need to get from point A to point B, you need a vehicle in order to get you there. And on this journey from 0 to 6 figures, the vehicle that you need to select in this context is something called your investment vehicle. Sounds fancy, but in simple terms, it's a financial product used by investors to gain a positive rate of return, which is essentially what we're all investing for. And there are a range of different investment vehicles out there, all with a varying degree of risk, from bonds to property to stocks to index funds. Now, typically an investor's portfolio will be driven by two things. Firstly, their risk appetite, and secondly, their investment objectives. Now, in a perfect world, we'd have zero risk and unlimited upside, but in reality, your risk appetite and investment goals are certainly a balancing act. So think about it like the lanes on a motorway. Are you the type of person who sits in the inside lane, tootling along at 50 miles an hour? Or are you the middle lane hogger who doesn't like to move and deviate from either direction and just stay in that same lane? Or are you the person that drives 90 miles an hour down the outside lane, absolutely tanking it, in order to get to the destination as quickly as possible? The person doing 50 miles an hour may take longer to get to their destination, but they're admittedly taking slightly lower risks from doing so, versus the person doing 90 miles an hour down the outside lane, who might get to their end destination first, but they're taking a hell of a lot more risk of potentially getting a speeding ticket, or potentially even worse, getting into a car accident. Now, unless you're a police officer, there's certainly no right or wrong answer here, or at least not in the context of investing. But knowing what investment vehicle aligns to your risk tolerance is absolutely key. Now, obviously can't tell you what investment vehicle that you should personally choose, because that's certainly individual to everybody and their own individual circumstances. But what I did want to touch upon is what Warren Buffett once said, and then I'll present some different options to you.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund.
So in this clip, he's recommending that just your average person should invest in a low-cost index fund like the S&P 500, which I'm certainly largely supportive of. It's certainly what makes up the bulk of my pension, which is just purely invested in a global equity market fund, along with my holdings over on Trading 212 and Vanguard UK, about £25,000 of which is made up of an S&P 500 ETF. Now, an index fund or an exchange-traded fund is an investment product that's made up of a collective group of individual investments, either equities, bonds, both. And they're all in one single fund managed by a fund manager. Let me share with you guys an example over on Vanguard UK. So here you have the target retirement funds like this 2050 fund. It has a portfolio allocation of 80% in stocks and 20% in bonds, capturing a number of different other funds from different geographical areas like America to the UK to even emerging markets, meaning that you have something called broad market diversification. Now, the beauty of these funds is that the risk associated with them teeters down the closer that you get to retirement, because naturally the closer that you get to retirement, the safer you want your investments to be. Here is a graphical representation of what that looks like, where the older you get, the lower your portfolio weighting to riskier assets like stocks. So funds like this are great for the passive investor that just wants to sit back and build their own investment portfolio for retirement. Now, there are many other funds available which you can get directly on the Vanguard UK website. If you've chosen your investment vehicle, the next part to the formula is value. And when I say value, I mean how much can you financially afford to contribute to your investment portfolio every single month. As a starting point, a personal finance rule that I personally stick by is that you should always look to invest at least 10% of your post-tax or take-home pay. According to the Office of National Statistics, the median salary here in the UK is £34,963. So assuming that you pay a little bit of student loan and contribute 3% towards your pension, that means you would have a take-home pay of £2,189 per month. So for the purpose of simplicity on what I'm just about to show you guys, let's just round this up to £220 per month invested into the stock market. Now, if we chuck those numbers into a compound calculator to see what our portfolio value would look like in 2050, which is 26 or so years from now, here is what you would end up with. Assuming a market yielding return of 7% per year, which is about average for the stock market, for 26 years, you'd end up with £195,176. Now imagine for some of you guys watching this video thinking 26 years into the future, you might be somewhat underwhelmed by that total portfolio size after investing for such a long period of time, because £195,000 26 years from now probably won't even buy your weekly food shop in Tesco's with the current rates of inflation.
Nothing left.
Now, of course, I kind of joke, but inflation is certainly a very key thing to think about. And we must do all that we can to combat it by increasing the value of our investment portfolios. Because the only way to accelerate the value of our portfolios that beats the rate of inflation is to increase the amounts that we can put into them. For example, just doubling your contributions from 220 quid to 440 quid would allow you to increase your portfolio value after 26 years to £390,352. £660 per month takes you to £585,000. Now, for context, Pension B have stated that the average pension pot is valued at about 180k, and that's from your kind of public sector pensions right the way through to your employee pension schemes. But imagine taking your personal finances into your own hands and actually being able to retire with 3 or 4, even 5 times that amount from the investments that you made yourself. So with that in mind, this is where I want to set you guys a bit of a challenge and an opportunity for you guys to enter a small competition too. One of the main reasons that I was able to increase my portfolio to over 6 figures wasn't just from my job and admittedly earning a fairly decent salary, but it was also from increasing my earning potential from starting a business too. The reason why that's important is because your earning potential is directly correlated to how much you can afford to invest, assuming that all other costs remain the same. If you can be disciplined in that and don't succumb to lifestyle inflation, you can grow your investment portfolio extremely quickly. So with that in mind, I want to help one of you guys out by scheduling a 30-minute call with one of you in order to help explore the potential possibilities of increasing your income too. Or to be honest, just whatever you want to talk about, no strict agenda, just whatever is going to help you guys the most. Now all you need to do to enter this competition is like the video, be subscribed to the channel, and also just drop this emoji down in the comment section below, along with the topic that you'd also like to discuss on the call. So pause the video, enter the competition now, and I'll announce the winner in 7 days' time. So vehicle and value are 2 important variables, but the third and final important variable is time. The longer your investment time horizon, the greater chance you have of seeing success in the stock market. Let me put it into context for you. Say we have 2 people, Sophia and Johnny. They both have the same aspirations and want to retire early at 55 in order to be able to enjoy the fruits of their labor. Now, Sophia is 22 years old and is currently investing £220 per month into a low-cost index fund, just as Warren Buffett suggested. By the time she retires 33 years from now, assuming she's able to achieve average market returns, she'd have a portfolio value of £341,895, which is roughly 2 times the size of the average pension pot. Whereas Johnny, on the other hand, is 35 years old. He's a little bit of a late starter, but has now decided to start taking his personal finances seriously. If he were to invest the same amount as Sophia, £220 a month, for the 20 years that he's got left until retirement, he would have an investment portfolio value of £115,492. That's less than 1/3 of the portfolio size that Sophia has. Now, the only way for Johnny to make up the shortfall is that he would have to hopefully rely on a bigger salary and being slightly higher up on the corporate ladder, and he would actually have to invest 3 times the monthly amount than Sophia has to just to get to the same portfolio value come retirement. But here's the crucial thing to point out. Sophia would have only had to have invested £53,000 of her own money, and the power of compound interest would have done most of the work for her. Whereas Johnny, on the other hand, would have had to have invested £159,000 just to get to the same position. So the earlier that you can invest and the longer that you can invest for, the better off you'll be because of the exponential growth associated with compound interest. It's the reason why Warren Buffett has collected 99% of his net worth after his 50th birthday. And that's largely because his investment time horizon has been over the course of the past 75 years. And now his net worth sits at over $130 billion. Now, I'm not sitting here saying that we're all going to become billionaires, but But with investing, the best time to plant the tree was always yesterday. So if you are in your early 20s watching this video, I can't stress the importance enough of getting started early, because over 10 or 20, 30 or 40 years, your future self will certainly thank you for it. All of this translates into the investing success formula, which is vehicle plus value times time equals returns. So pick a good investment vehicle, dial up your investment time horizon, and increase the value that you can contribute as much as you can, and the bigger the portfolio size will become. Now, the UK stock market would probably be a natural choice of investment for many of you guys watching this video, but a word of caution, it might not be the best investment vehicle for you. So be sure to click on this video next in order to find out why.